Job growth jumped slightly more than expected in August. 187,000 jobs added compared to the 170,000 estimate. Unemployment rose, however, to 3.8%. That's up from 3.5% in July. Joining me now to sort through these contradictions is T. Rowe Price, head of Global Multi-Asset Management, as well as Chief Investment Officer Sébastien Page. Seb, thanks so much for coming on the show.
Thank you, Jack.
So let's start with some of these areas of conventional wisdom where you think the market might have it wrong. Of course, asset prices are based on expectations. If expectations are wrong, that makes things interesting. What is the market not getting right?
Well, the narrative this week is that the labor market is cooling. I'm not convinced yet, Jack. Look, we have 8.8 million open jobs. And the pre-pandemic average was 4.5 million. And the most we got in the 20 years leading to the pandemic in terms of open jobs was 7.6 million. So we're at an incredibly elevated number of open jobs. You can question the data, but to me, this means that the labor market is not necessarily cooling. The conventional wisdom of the week also is that this is going to mean that we have more confidence that inflation is coming down. And I think it is coming down, but there's upside risk, Jack. That's the takeaway.
You also take a look, shall we say, into people's checking accounts, into their money markets accounts, and you're seeing an awful lot of cash on the sidelines, which may or may not be recognized by the market at large.
Right. Again, the narrative is we're running out of so-called excess savings. There are lots of adjustments behind those excess savings measures, and they're hard to estimate. A lot of economists have said we're running out for the last 10, 12 months. I just look at raw data in aggregate. It's not equally distributed. In checking accounts, I see 4.5 trillion. What did we have before the pandemic in 2019? 1.2 trillion. And then add on top of that 4.5 trillion cash in checking account, 5 trillion in money market funds. Jack, there's so much money in the system still. And that means that, as one of my colleagues put it, there's a blob of money. There's a giant blob of money eating a lot of the negative headlines.
That's a great image. So in this environment, what areas of the stock market to you offer the best risk reward?
So I think now's not the time to be a hero. Cash is attractive. It gives you 5%, but now's not the time to be completely out of the market. We don't do that anyways because we invest for long-term investors. But now's not the time to load up on cash either. So we have a fairly balanced portfolio. What we're doing is taking advantage of relative valuation opportunities. Jack, if you missed the rally this year, you can sort of chase momentum and go into large cap stocks. You can wait for a dip so that you can get back in. Or a third option, which is what we're doing, take advantage of relative valuation. Go into markets that haven't participated as well, as much as the rest of the market. I think small cap stocks, for example. We also think high yield is attractive right now from a valuation perspective.
That's interesting. So high yield, we're finally getting some high yields. I think it's about 9% right now. But the spread between that and where treasuries are trading actually is not particularly large. How do you break that down?
Yeah, that's a good point. The spread is not large or wide by historical standards, but the total yield for an asset allocator is quite attractive, say 9%. The yield on stocks, the earnings yield, is about 5%. That spread, that valuation spread between total yield and high yield and where the stock market is trading at 20 plus price earnings ratio is very wide by historical standards. So because rates have come up, I'm an asset allocator, I expect maybe average default rates in the high yield asset class for the next 12 months. I invest in actively managed strategies where you can hope to bring that down closer towards zero. On a relative basis, we still own stocks, but on a relative basis, if I'm going to add to return-seeking assets, I'm going to do it in high yield rather than stocks for the next 6 to 18 months.
All righty. Well, we'll check back with you after that time and see how that trade is done. Sébastien Page, thanks so much for coming on the show.